Most recently highlighted by your financials team, we're 7 months into the sub 330 claims environment. The last two cycles lasted 31 and 45 months before the market top. Can you address that? What are your thoughts on that?
Well, I think that this one's, again, we have a slide on that to show that anytime you get sub 300,000 claims, that's actually an explicit sell signal. Whether or not you're 5 or 6 months early, we can leave that up to the market to decide. I think the market, where I like to be shorted, is definitively deciding that this is on to the risk side. So again, the Russell 2000 is down 10% since its all-time bubble high in July the 7th for a reason. Bond yields are falling for a reason. So these are big things that are falling, and a lot of early cycle stuff is falling in kind. So again, while it looks good, it should look good at the end of a cycle. And again, if you're investing pro-cyclically, that's the mistake here. I think you need to acknowledge what is an early cycle development, and by the time we're into the soup again, the jobless claims chart will look like it always looks, which is it looks bad, and then you buy things again.
Along those lines, I'll add another question in here. What carries more weight for Janet Yellen, inflation, housing, or employment? Employment seems to be doing well. How do you see the Fed reacting if employment numbers stay favorable?
Well, I don't think on those three things, I don't think that inflation has ever really mattered to this edition of the Central Planning Committee. I think housing is a huge ideology for Janet Yellen, in as much as it was on the fiscal side of the House with Barney Frank. So this level, I think that's what really scared her. If you look at her comments in Jackson Hole, or if you look at how she backed off the considerable time pressure she had at the most recent meeting, I think the most obvious data to her is the housing data slowing. The next part is where the shoe drops. That's where I think she'll freak out. I really do. I don't think she has it in her, on her watch, to see unemployment after it's dropped from 10 to 8 to 6%, going back towards 7% and getting hawkish into it. That is not in her DNA. It's not in her playbook. So I think, again, the classic difference in my view versus hers is that she looks at employment as a leading indicator when in fact it's a lagging one. And we're already seeing the early cycle slowdown indicators that are basically front-running her behavior on that. So on bad employment data, I think she gets acceleratingly more dovish.
And if she remains or gets more dovish, will that result in a devaluation of the dollar and reinflate commodity prices? If so, would that kick us back into quad 3?
Well, this is a great question too, because the correlation risk in the market right now is probably at its highest point. The correlation risk, I mean U.S. dollar versus. So if I look at the U.S. dollar versus the Nikkei, the U.S. dollar versus the CRB index, the U.S. dollar versus Brent oil, the U.S. dollar even versus the S&P 500. The correlation risk after, really this was the biggest currency move we've seen since 1997, is surreal. So if I'm right on a lot of things here, again, a lot of things I think the market's saying could be going my way. If they don't, they don't. I'll be wrong. A lot of other people have been wrong. But if I'm wrong, that's fine. If I'm right, this is the point. And growth surprise on the downside, she gets more dovish. The dollar should act negatively in kind, because Draghi's out of ammo. She's got more, she can go back to the quantitative easing, forget it. She can go back to untapering the taper. She can go back to quantitative easing. She can go to QE4. She's got a lot of clubs still left in that bag. And I think that's what she's going to do.
On that front, we have a number of questions here all related to the consumer. If your inflation accelerating theme led to your consumer slowing theme in recent macro presentations, what factor or set of factors leads you to believe that the recent commodity price deflation will not result in continued acceleration in consumption growth?
Well, the first thing is, again, which we showed in the slide deck, is that the tax cut comes on a lag. So companies don't cut price in real time. Real-time prices in markets do. So you get deflation in real time in your portfolio, and you get an investable thesis developing on a different duration. Now, I think we were as bullish as anybody on Wall Street in April 2009. That's where we bought Starbucks at $11.52. Not that I keep track. But again, that's where you invest. Today, you see a bunch of people telling me how great of an investor they are when they didn't want, like they were scared of their own shadow when it was time to invest. You have to wait till there is some serious pain out there, and you can see it already. A lot of people bought the consumer discretionary stocks as soon as oil started to tick down. Last month, the consumer discretionary stocks were down over 3%. They're already down 2% for October, and I think October is like a day old. So again, you have to be timing right. I respect timing because I was on the buy side, and being wrong on timing means, well, ultimately means you can get fired. So again, I want to be really, really tight on this, and I don't think you get an easy comparison on consumption until the first quarter of next year. So again, a lot of people would say, well, that's 3 months away. Okay, well, don't be averaging down too aggressively until a couple more of the cards that we've laid on the table play out.
Okay, and again on the consumer, the recent ICSC data showed that the consumer seems to be back. I think there were 2 data points at least in a row. How do you see the squeezed consumer you spoke of in recent quarters with regard to the most recent retail sales trends?
Well, I mean, ICSC, first of all, I think is 80 companies. So it's not as bad as a survey, but it's not good enough for me. I don't make my entire macro call based on that. Again, it's rate of change. So as we go through, can you envision an environment, or could the people that are now bullish on consumption that weren't bullish on consumption with inflation falling before? It's kind of hard to find that thesis because they would have had to have the prior thesis. But again, if you go through this and you start to see housing prices go back to low single digits up for the year over year, and the U.S. stock market is down in P&L terms for the year, what I would suspect is that a lot of these high-frequency confidence readings will roll over. Purchasing power will be negated to some degree by confidence. Savings are going up in that environment. So again, threading that needle is pretty tight. By the way, we're talking about the worst performing sector of the S&P, which is the consumer. So the market's telling me, wait a little bit longer. And again, I'm in no hurry here.
So we're waiting on that section, the consumer discretionary stocks. Of those stocks, what do you see as the best shorts if we enter a recession? What types of stocks and what names specifically might you call out?
Well, a lot of people who are focused on trying to get me bullish on consumer are focused on the cost side, okay? They're not focused on the freak out or the employment side. Now, I can tell you with a level of 100% certainty that 8 to 10% unemployment rate reported in this country is going to create less traffic. So you have to really think this through. If we go through an early cycle recession, you can't use peak utilization as your model. You can start to take down the cost, you can start to take down different components, but you can't. This is a model that moves on different durations. And again, I think that would be the biggest thing that I'd be thinking about there. I'd be thinking about labor. What happens if we go back into another labor recession? I'd argue that we're already entering it.
Okay, and we've got a couple more here. We're going to try and keep this tight. This just in, given the absolute level of interest rates, why would REITs underperform relative to the S&P during this cycle?
Because they've outperformed so magnificently coming out of this cycle. I mean, REITs, I think the main problem, again, REITs should act fine relative to something that's hyper-deflationary. I'd much rather own a REIT with rates down here, because again, it's called yield chasing. That's why we have so many REITs. It's a very efficient exercise Wall Street's gone through to create assets that replicate what the investor needs versus what the investor maybe is thinking about. So again, it's got a yield. So I like things with yield. So you could start there. The problem with REITs is the embedded value of the REIT on the asset price. So if we get deflation, I mean, an apartment just went for $130 million on the right near where I used to live in New York City. It's like people don't think that real estate can deflate. And there's some pretty prominent guys out there, not the least of which are Barry Sternlicht, that, and you can kind of do your own work on this. But the reality is that these castles in the air don't go up forever. And I think that the main risk to REITs, which is again, it's a quad 4 reality, is that any kind of asset deflation on the real estate side, commercial or residential, would have some kind of an impact versus, again, a sector that was up 20% for the year to date. There's an expectations mismatch as much as anything else.
And I think these last two are somewhat correlated. We're getting back now to quad 4 versus quad 3 questions. Can you talk through how things changed this year as we went from growth slowing as inflation was increasing and now growth slowing as inflation is decreasing? Maybe contrast the two?
Yeah, so just to be clear, the contrast was, I guess, causally impacted by a central plan. So Draghi woke up and he said, look, I'm not going to have a $1.40 euro because the Italians and French told me they don't like it. He started to devalue. So you started to get the ball rolling. The dollar started to rip. And when you start to make markets and economies react to markets based on central plans that just randomly come out of anywhere, these are the risks. So that's what happened. That's what drove, the U.S. was in a pretty good place. You know, if it could just hang out in Quad 3, eventually get something that could drive them back to the first quadrant. But now they have to go through the fourth quadrant first. And that's really what happens, is when the world says, oh my God, we're going to get some real currency volatility because these currency guys have all cut to zero and their next move, we don't know what that could be. That's what happened. So you go from the third quadrant to the fourth quadrant where nothing works because people truly don't trust it. Again, all these guys in Japan, Europe, and the US have promised the world certainty. They would create economic growth, real economic growth. And now that they don't have it, people really have to get creative in their minds that 0 minus 0 is greater than 0. And again, I think that's the main problem that you've seen happen from an asset price perspective, is going from the third quadrant to the fourth quadrant. It's very deflationary. I'd much rather be in the third quadrant because at least I could own energy, commodities. I could just like outrun that poor bastard who's getting cost of living jammed down his throat and just own it. Now I can't even own that because I'm getting deflation on that side.
You showed a slide that you said, I think, an economy stayed in Quad 4 for a cup of coffee and went right back to Quad 3. What do you look for as catalysts for this move into Quad 4, and perhaps what will it take to get back out of Quad 4?
Well, there was another cup of coffee in the U.S. in 1987. I mean, the cup of coffee can burn. I mean, deflation is serious stuff, Bob. I mean, this is much more serious than the drugs Draghi's dealing. The deflation happens fast because people don't, in their heads, they don't either believe it or they're not allowed to believe it. Equally problematic. At this point, people don't think asset prices can crash. They don't think that they can deflate. So what the deflation does in the fourth quadrant, it could be a cup of coffee, it could be on your head, it could be on your lap, it could be something that you have constant burning. I don't know what that would be. But this is something that I'd actually rather see than that slow drip of being Japan kind of hovering around the no man's zone of Quad 3 forever.
We've mentioned Europe, we've mentioned Japan, and certainly the U.S. How does Quad 4 and Europe slowing impact China and EM growth?
Well, I mean, EM is right freaked out about the dollar at this point. So again, Draghi doesn't, God didn't call Draghi and tell him to worry about the poor guys in the emerging markets. And again, that's the problem with assigning such unelected central power to these people. All these things are interconnected. And if you don't believe that, it doesn't matter because they are. They have extremely high correlations. US dollar index, again, doesn't matter what you think of the basket of what the US dollar index is. This is what the machines chase. They chase US dollar index correlations to big macro. And again, that's what has basically occurred, and that's why you're really in a place, dare I say, you're kind of like at the point of no return. I'm very, very nervous about this because I don't know how this is going to go next time, other than the Fed's next move, which is to move the dollar down, and then you get a whole nother ball of wax of currency volatility.